Hello, my name is Russell Myers. Welcome to And Unity for All. Yesterday I talked about the consolidation of wealth, and today I'm going to talk about one of the major mechanisms of that, which is corporate buyback of stock. The Federal Reserve is expected to completely end quantitative easing via increased interest rates in June of this year. What does that mean? It means corporations are in panic mode right now. In the first quarter of 2018, corporations performed more than $240 billion in stock buybacks. Now, what does that mean? Why do companies do this? Well, part of this is that it results in reduced taxation. When companies issue stocks come with dividends. People buy part of a company, they want to see part of the profits from that company in the form of dividends. So when the company buys back its own stock, when they pay out the dividends, they count that as a cost on taxes. So when they own the stock, they're paying the dividends to themselves. Stock dividends are taxed at a lower rate than straight corporate profit is taxed at. So they are using their profits to pay out stock dividends, counted as a cost, pay themselves the dividends, and pay a lower tax rate. Got that? All right. One of the biggest problems with all of this is how companies will buy other stock in other companies. And that inflates the perceived value, even though there's no collateral that's involved here. Say company A buys stock in company B. That increases the holdings of company A, makes it look like company A has more value. Problem is company B buys stock in company A, which increases the perceived value of the holdings of company B. And then company C comes in and buys stock in company A and B, and so forth and so on. This is dangerous because as soon as you have one large corporation that winds up with reducing their value, their stock value, then it has a cascade effect. Most of the investors have triggers built in. They're programmed in. It's automatic. It just happens because they already have it set that way. Say company B has a trigger that if company A's stock drops 10% value, sell it. So, but now they're no longer holding that stock, and they've taken a 10% hit on their investment. Well, that reduces the value of what company B is now worth. So company A hits a trigger and they sell off the stock in company B. Company C sees the drop in value and they sell off their stock in company A and B, dropping the value of all three of them all at the same time. And this can happen within hours, maybe minutes, because it's all computerized and it's all automatic with preset triggers. Who takes the smallest hits? The major investors, because they already have those triggers set. And they buy their stock at high value. They buy their stock because they don't care about the dividends. What they care about is buying stock low and selling it high. Once you start raising the interest rates, you stop quantitative easing, that's the market peak. They're going to sell at the peak because they don't want, there's nowhere for it to go but down now. So they're going to sell and take their profit and pull out of that market. So that drives the market down. This is all coming. Other countries have been performing their own quantitative easing and creation of, just printing money to buy stocks in American companies. Well, they hit their triggers, they sell. All of this comes down and devalues the dollar. When the stock market plummets, the dollar is devalued. What else happens? These companies wind up losing so much money that they wind up declaring bankruptcy. Well, they have nothing of any value because their value was all on this, ethereal stock, which is 10 times the value of any actual solid holdings they've got. They've got nothing to sell. They declare bankruptcy. The banks still want to get paid. The banks are still saying, well, you owe us this money, but now we're going to write it off. Well, what happens when they write it off? Well, now the U.S. government is on the hook for the money. When the U.S. government is on the hook for the money, what happens? You're on the hook for the money. So, all the corporate executives and the major investors, they walk away with their money. The government tries to take out loans. Well, now the dollar is devalued. Nobody wants to loan us money. So you got companies going bankrupt, thousands of, possibly millions of jobs lost within days. And there's nowhere to go with this. So your best bet right now is to pull all your money out of the stock market before June. You need to pull as much out as you can. If I'm wrong, okay, fine. Go back and invest it. At the very least, you're going to see a drop in the stock market. Take your money out now, take your profit, and when stocks drop, then buy in again. That's investing. So that's how investments work. So get a jump on it. Don't wait until your money in your 401k or IRA or whatever, cash it in. Somebody else is holding your money. Chances are you don't even know what's in your portfolio because it's all one big group folder. That's the meaning of portfolio. It contains a whole bunch of different stocks. Do you know what's in your stock portfolio, in your retirement account? Sell it. So this is coming. You can't blame Trump for it. I mean, this has been going on for decades, especially since 2008 when quantitative easing started. But in truth, this all began back under Reagan when he deregulated the ability of companies to own their own stock. It's ridiculous for companies to own their own stock. So anyway, please share this video. Please hit like and subscribe. Get ready for what's coming. And I'll talk to you later.